Passive income is the internet's favorite buzzword. It's sold as an effortless hack, a secret trick to quit your job and get rich while you sleep. Building wealth through dividends relies on a rigid, defensive mathematical strategy. To see what actually drives market returns, we have to look at the historical data of the S&P 500 going back to 1960. This chart tracks $10,000 over 6 decades. Compare the flat gray line, stock price alone, to the towering blue line showing total return with reinvested dividends. 85% of the cumulative return comes strictly from this compounding power. Securing a cash flow that covers your expenses without forcing you to sell off your underlying assets requires navigating a specific multi-decade roadmap. Earning passive income involves a strict equation. You trades either a massive amount of upfront capital or decades of time to secure your financial freedom. Let's establish a standard, comfortable retirement goal, generating $100,000 in annual passive income from safe, reliable blue-chip stocks. To figure out exactly how large your portfolio needs to be to hit that target, we use a very specific mathematical formula. This graphic shows the required investment equation. You divide your desired annual dividend income by the dividend yield. Let's walk through the calculation using a safe blue-chip dividend yield of 3%. You divide your $100,000 target by 0.03. To earn that income safely, the calculation demands a massive upfront lump sum of $3.33 million. If we map out lower and higher yield scenarios, the capital burden becomes clear. At a 1% yield, you need $10 million. At 3%, $3.33 million. Even at a 7% yield, you still need $1.4 million in starting capital. This high capital requirement creates a dangerous psychological trap for novice investors who lack millions in liquid cash. They often try to bypass these requirements by chasing struggling companies offering 7 to 10% yields, businesses that frequently slash their payouts to survive, wiping out the original principle. Without a massive lump sum, chasing high yields often destroys wealth. Average investors must switch their primary weapon from capital to time. If you are starting from zero, the path forward relies on the dividend snowball. This diagram illustrates the 3 engines driving the snowball: investing net new capital, companies increasing dividend payouts, and automatic dividend reinvestment. The driver of exponential growth is this third step, dividend reinvestment, or DRIP. Here, your broker uses cash dividends to immediately purchase more shares. Let's apply this to a realistic dollar-cost averaging scenario. Dollar-cost averaging means investing a fixed amount of money on a regular schedule, regardless of market conditions. In this case, a strict, automated $500 a month into a standard dividend portfolio. This chart projects a $500 monthly investment over 35 years. Notice when the math takes over. Around year 15, the blue with reinvestment line rockets upward. By year 35, you've built a $3.8 million portfolio, paying $90,000 annually. The psychological toll of this strategy is grueling. For the first decade, the compounding feels slow and practically invisible. Time is a more powerful force than starting capital, but it only works if you possess the emotional discipline to automate your reinvestments and ignore your portfolio for 15 years. To execute this strategy safely, we need to move from mathematical theory to the actual market vehicles. The standard for this approach is a specific group of stocks known as the dividend aristocrats. The criteria to join this exclusive list is strict. They must be S&P 500 companies that have delivered 25 or more consecutive years of dividend increases. These businesses have serious pedigree. They are massive, stable, old economy titans that have survived decades of economic turmoil. This elite group relies heavily on the most predictable sectors of the economy, specifically consumer staples and industrials. This chart plots sector volatility against dividend reliability. The aristocrats cluster tightly in the high reliability, low volatility corner, far away from the high-risk, high-reward tech stocks that dominate the broader market. The ultimate historical stress test for their absolute underlying safety occurred during the massive 2008 Great Financial Crisis. While the broader S&P 500 crashed 38% and slashed dividend payouts by 21%, the aristocrats fell significantly less and continued to raise their payouts. However, this extreme safety carries a cost. You will likely underperform during massive economic bull runs. The aristocrats only hold a 3% allocation to explosive tech stocks, compared to over 20% in the S&P 500. They simply cannot keep up when the tech sector surges. By buying aristocrats, you intentionally sacrifice maximum total returns in a bull market in order to guarantee you never have to sell your assets in a panic during a crash. Executing a dividend strategy successfully comes down to identifying which mathematical lever you are pulling. This flowchart maps out your strategy based on your current resources, splitting into high capital on the left and high time on the right. Consider the pre-retiree profile, those who already possess a large amount of capital but lack a long time horizon. Their operational mandate is straightforward. Their goal is to move capital into safe aristocrats to generate defensive cash flow, willingly accepting lower growth in exchange for sleep-at-night security. On the other side is the beginner profile, those starting from zero who have decades of time to leverage. Their mandate is rigid and highly automated. Ignore complex price-to-earnings ratios. Open a zero-fee brokerage, buy fractional shares, automate a $500 monthly deposit, turn on auto-drip, and do not touch it. Avoid the distractions of internet hype and extreme yields. Align your strategy with the resources you actually have. Automate the math and let time do the heavy lifting.